Hi everyone, and welcome to our semi-annual investor webinar for the Totus Alpha Strategy. I'm joined here today by Tim Warner, my co-portfolio manager, and Jack Cherry, our analyst. Please take a moment to have a read of the disclaimer on your screen. This webinar is for general information purposes only and is not intended to provide you with financial advice. It has been prepared without taking into account your objectives, financial situation, or needs. The webinar is being recorded and a link will be made available after the session. Today I'll start with a quick overview of Totus and a reminder of the objectives and expectations for our Alpha strategy. I'll give you an update on recent performance and I'll take you through some high-level market observations and takeaways from our recent research. Tim will discuss some current themes we're exposed to in the portfolio. Jack will then present a long and a short position, and we'll cover off some Q&A at the end. Totus is an absolute return manager focused on developed market equities. Our long-short alpha strategy was designed to maximize risk-adjusted performance over the long term. Our objective is to preserve and compound our investors' capital alongside our own, regardless of conditions in the broader equity market and economy. Our alpha strategy has delivered strong investment performance of 14.6% per annum net of fees since April 2012. This return is over 5% per annum higher than the ASX 300 index, including dividends over the same period. Importantly, these returns have been uncorrelated with Australian and global share markets and delivered with an average net equity exposure of just 35%. This slide shows the fund's performance versus the Australian share market, MSCI World Index, and the cash rate. It shows that not only has the fund delivered outstanding absolute returns over the nearly 11 years of its life, but it's also delivered strong positive performance when clients have needed it during periods of market weakness, such as the European debt crisis in 2012, the COVID crash in 2020, and the 2022 sell-off. Many of you will have seen this slide, but we think it's important. It shows that we are a genuine, true-to-label alternative investment that has delivered positive returns on average in up and down markets. Our performance of positive 0.9 in ASX down months is something we are particularly pleased with. Turning now to performance. We are really pleased with the performance of the Alpha strategy in 2022, coming as it did during a very tough year for stocks internationally and after a strong 2021 return for the strategy. Producing a 13% return in a down year for stocks is why we think it is worth having a product like this in your portfolio. We did it by pivoting our long exposure away from tech and into resources early in the year. Unsurprisingly, our short book was the standout driver of returns last year, up 26%. So far in 2023, the going has been a bit more difficult. Equity started 2023 very strongly with a rotation out of last year's winners and into last year's losers amid optimism that inflation might be coming down. Our cautious positioning hurt us in the first 2 months of the year, but that underperformance has narrowed since mid-Feb as gravity from a weak reporting season and concerns about sticky inflation and now bank failures has given the market some food for thought. In 2022, the Australian market materially outperformed the US due to its heavy exposure to resources and banks. Historically, we've done more of our shorting in Australia rather than offshore, so if the Aussie outperformance isn't repeated in 2023, that could on balance be helpful for us. We are stock pickers, not macro traders, but we do think it is worth keeping an eye on overall market conditions as a sanity check on our portfolio positioning. Once we have collated our list of stocks with exposure to the best themes in the market bottom up, we then look at our net and gross exposure and ask ourselves if that makes sense in light of overall economic and market picture top down. In this section, we'll quickly run you through some of the most topical top-down issues facing the market as we see it. First of all, rate hikes. I think it's important to recognize that the RBA and the US Federal Reserve have been hiking interest rates at the fastest pace on record. They are increasing these interest rates into a system that is extremely leveraged by historical standards. Governments loaded up on debt during COVID and then kept spending long after they should have slowed down. In the USA, corporates have loaded up on cheap debt to pay for stock buybacks, and in Australia, many of us went nuts on property debt when the RBA assured us that rates would stay lower for longer. Not only are central banks increasing rates at a record pace in the USA, but the Fed is also attempting to wind down its balance sheet, which over time reduces the liquidity available to buy risk assets like equities. The X factor in this equation is inflation. While goods and energy inflation has been falling in recent months, this is being offset by services inflation, which is proving more sticky. There are a number of factors that are contributing to this sticky inflation that are difficult for the Fed to influence with rate hikes and QT. For example, deglobalization is reversing a long-term source of deflation from China. The green transition, or decarbonisation, which is inherently inflationary as you replace existing infrastructure with duplicate and sometimes higher cost alternatives. And finally, tech companies are now pricing their services for profitability rather than market share, which is also inflationary. This creates a problem for central bankers as sticky inflation makes it hard for them to step in and support markets when they fall. The ability of governments to add additional fiscal stimulus is also hampered by the large debt and deficit levels they are already running. It's a very different setup to the environment we have enjoyed during our investing career today. We discussed this in our last webinar, but as a quick reminder on why inflation is bad for equities. Companies experience rising costs at the same time that their customers are facing affordability issues. This leads to margin pressure and lower profits. Inflation also results in companies needing higher levels of working capital to produce the same dollar of profits, which leads to lower free cash flow left over for shareholders and lower real returns on invested capital. This leads to lower valuation multiples for equities during inflationary periods. Recession is a word that has been top of mind for investors and corporates in recent months. So in this section, I'll quickly run through some recession warning indicators that are currently flashing red. First of all, the 3-month, 10-year yield curve, which has predicted 8 of the last 8 recessions in the USA. Every time it has inverted, a recession has followed soon after. The strike rate is 100% and it is currently inverted. The Conference Board leading economic indicator is also a good predictor of impending recession. Every time it has dipped below -4. It is currently at -5. Next, bank lending. Tighter bank lending standards have preceded every recession since 1990, and lending standards have been tightening since the beginning of last year. It is tighter lending standards as a fallout from the recent bank failures in the US that is a bigger risk to markets than bank runs in our view. Finally, if we look at unemployment, based on the Fed's own forecast for a 1% increase in the US unemployment rate during 2023, that has led to a recession on 12 out of 12 previous occasions that US unemployment has risen by over 1% during a 12-month period. Pulling it all together, our assumption is that a recession in the USA is a very high probability. If a recession is likely, the next question logically is, how bad is it going to be? First of all, it's worth pointing out that all landings look soft to begin with. And the second point to note is that soft landings are rare. There have been 8 recessions since 1960 in the US, but only 3 soft landings, a 37% hit rate. Importantly, none of those soft landings came during the previous inflationary period during the 70s. In fact, there has never been an episode where inflation has been above 5% when it has come back down below 5% without a hard landing recession. We are currently at 6% inflation in the USA and 7.4% here in Australia. This is what Jerome Powell means when he says it will require some pain to get inflation back under control. The chart below shows that equities bottom during recessions and not before them. In fact, US equities have never made the cycle low before a recession begins. If Fed hikes are causing a recession, surely a pivot should be good for stocks. In fact, history shows that stocks have never bottomed before a Fed pivot, and in fact usually bottom well after the Fed has pivoted. 14 months after, in fact, and the average fall from a pivot to the bottom in stocks is 28%. Turning now to reporting season takeaways. Our view is that the reporting season just gone was weak. After the COVID-fueled boost to cash flows of 2021, many companies are now reporting much weaker conversion of cash flows into profits. Historically, this has been an excellent lead indicator for earnings weakness ahead. Like-for-like sales growth was slowing, and many companies are now carrying too much inventory. Affordability is becoming an issue for the low and mid-end consumer, and companies like Domino's are finding it difficult to pass on price increases. Finally, we noted a number of companies sticking to their earnings guidance, but relying on a strong second half performance to get there. Given the tougher economic backdrop, these companies look ripe for earnings downgrades in our view. We also attended the Morgan Stanley Tech Conference in San Francisco earlier this month, and were surprised to see a record attendance, up 20% from the previous peak in 2019. Artificial intelligence was the hottest theme at the conference, replacing crypto and the metaverse in 2022. We've penciled this in as an area for further research, both long and short. Investors and corporates seem cautiously optimistic that costs could be removed and margins expanded without undue impact on top-line growth. Given that one firm's cost out is another firm's profit warning, this seems a stretch to us. While we're in the US, Silicon Valley Bank failed and tech layoff announcements continued. On balance, it didn't seem like the type of conference you would expect to see at the bottom of a bear market. So what's priced in? Taking the US market, which is the most robust data, as our example, if we look at what sell-side forecasters are expecting for company earnings, we can see that after a huge pop in earnings post-COVID, the expectation is for earnings growth to fall in 2023, but not to go negative, before rebounding about 10% in 2024. Given that earnings have fallen over 10% in the 3 previous recessions this century, we can therefore say that Wall Street consensus is not currently forecasting a recessionary outcome for earnings in the US. If we then turn to valuations and ask ourselves, are equities cheap or expensive based on these relatively benign earnings forecasts? The answer is no. This first chart comes from our prime broker Morgan Stanley and their excellent strategist Mike Wilson, and it shows that equities are flashing red, expensive, relative to their main alternative bonds going back 16 years to 2008. The next chart comes from Guggenheim and looks at where equities have historically traded over a range of experienced inflation levels. Translating it for you, what it says is that during previous periods of inflation of circa 6%, like the one we are experiencing now, US equities have traded on an earnings multiple of roughly 15 times. When we stack this up against the current US market multiple of over 18 times, we can conclude that the market isn't cheap relative to history yet either. So pulling this all together, we have record tightening into a highly leveraged financial system. We have sticky inflation that makes it hard for central banks and governments to step in and support markets during a slowdown. We have all the major recession indicators in the USA flashing red, and we have earnings starting to weaken as inflation and rising interest rates start to bite. The market's earnings forecasts look optimistic given the circumstances we are facing, and equity valuations aren't cheap versus bonds and aren't cheap relative to history. So what does this all mean for our positioning? It means that we remain positioned for a downturn in equity markets. We are running lower than average net and gross exposure, which makes it easier to manage market volatility and means we do less damage to our portfolio if we are wrong. We continue to take profits on short positions into sharp sell-offs and attempt to buy quality businesses at attractive valuations during market volatility. We try to stay open-minded and nimble. I'll now pass over to Tim to run you through some portfolio themes.
Thanks, Ben. I'll now run you through some of the key portfolio themes to give you some insight into where we are currently focusing our research efforts. At Totus, we are bottom-up stock pickers, but are aware of the macro environment we are in. The opportunity set currently continues to look more favoured to the short side, with a potential recession on the horizon, sticky inflation, and valuations remaining elevated across the market in an absolute sense, and especially relative to bonds. So let's start with the short side of the book. With the possibility of a recession on the horizon, we are of the view that you want to be short economically sensitive names, such as consumer, retail, housing, and travel. In the retail sector, we are looking for companies where demand still looks inflated from the COVID boom, margin expectations are above long-term trend, and inventory levels that are elevated above historical norms. A reversion of one or more of these trends could lead to operating deleverage and a downward earnings trajectory, leading to share price underperformance. Some stocks within this thematic include a kitchen appliances company where demand for their products boomed during the stay-at-home COVID period and currently has inventory levels 50% greater than historic averages. An auto parts accessory company with operating margins 650 basis points higher than historic averages, elevated inventories, and consensus expectations not factoring in a material margin reversion. Finally, we're short a golf equipment company. Golf is an industry where demand has recovered a 20-year structural decline in the space of 2 years during the pandemic. Furthermore, margins of their most discretionary segment, golf clubs, are elevated by 360 basis points versus history. We think all these stocks have meaningful downside in an environment of slowing demand. Moving on to housing. In Australia, house prices have had their fastest and most severe decline since the 1990s, declining nearly 10% in just 10 months since their peak in the middle of 2022. Furthermore, it is estimated by Barrenjoey that over $350 billion of fixed-rate loans are expected to roll off through 2023. Housing affordability looks questionable to us under a higher rate environment, and a continued decline in house prices will not help consumer confidence. In the US, mortgage rates are at close to 7%, the highest level in 20 years, and more than double what they were 12 to 18 months ago. This large increase, as you can see on the graph, has resulted in affordability and refinancing issues, driving down residential construction spend, which peaked in May 22 and is down close to 10% from its highs. We are short a basket of US home builders and select Australian building materials companies where we believe price levers have been tapped out and volumes have further to fall, which will hurt margins disproportionately to the downside. Also, we are short Lowe's, which is a home and hardware retailer in the US, the number 2 competitor to Home Depot. Lowe's profitability per store surged during the pandemic by over 100% compared to the 7-year average prior to COVID. Based off previous housing downturns, we don't think this time is different and think demand will slow and margins have further to fall due to their inflated starting points. The recent quarterly management calls show that volumes are beginning to slow and management is becoming cautious. Now, with travel, we may be too early as the boom continues post the pandemic lockdowns, but travel, and in particular corporate travel trends, tend to underperform in economic downturns due to company cost cutting. In addition, according to the Airlines Reporting Corporation, the rebound in corporate travel in the US seems to have stagnated at 70% of pre-COVID levels, and we believe this could signal that there are some longer-term structural changes to corporate travel. Outlooks from select travel companies are implying extremely strong second half skews and requires a lot of investor faith to trust the management team. Also, the profitability of Australia's major airline looks unsustainable to us in the long term. Positioning in these names has been crowded due to the reopening narrative and earnings upgrade stories, and we think any sign of a slowdown could shake out loose hands and short-term shareholders. Some other short themes in the book include short Aussie banks, which we believe are at peak earnings and are trading at near all-time highs. Commonwealth Bank's net interest margins peaked in October, and competition looks to be increasing with a mortgage cliff in sight. We're also short a range of resource companies with exposures to more economically sensitive resources like copper and iron ore as a hedge against our core longs in the commodity space. Lithium FADs, which consists of a range of Australian listed explorers that are pre-revenue, pre-production, operating questionable jurisdictions, or have unproven technology. And finally, the ASX 300 index inclusions continue to have weird and wonderful names entering the space with zero revenue, no commercial products, but billions of dollars of market cap, which Jack will touch on later. On the long side, our core backbone of longs remain relatively unchanged, but in smaller position sizes due to our lower gross exposure. Undersupplied commodities is a theme we pivoted to in 2022 and had great success in the energy sector. And recently we've shifted our focus to met coal. In the commodity space, we look for industries where capital has been starved and where there are supply shocks. Met coal is in structural undersupply due to ESG policies and tough regulatory and political pressure. Yet the commodity is essential to the production of steel, which is needed for a renewable energy transition. These supply issues have been exaggerated by the tragic Ukraine invasion and causing upside volatility to the commodity price. Australian premium coking prices have more than doubled from 2020 lows, resulting in an abundance of free cash flow generation from mine operators. We believe that equity values across the sector are not pricing in this upside from the elevated prices, and a long-term average of mid-$100, the industry still looks very attractive. Our main exposure is Stanmore Resources, listed in Australia, which Jack will talk to in more detail soon. Inflation continues to remain topical as core inflation and wage pressures look to be sticky. Inflation kills a typical company as it increases their costs and degrades their returns. Pricing power and low capital requirements help offset this, and due to our quality bias to investing, the majority of our long positions have these attributes, which is favourable. There are also several companies in our long portfolio that are benefiting in more direct ways from the impacts of inflation. Firstly, interest rate volatility has been heightened due to the Fed's effort to tackle inflation. This uncertainty has led to increased hedging activity for CME Group, which operates the leading exchange for interest rate derivative products. Additionally, the unwind of the Fed's balance sheet should lead to growth in US Treasuries being held privately and provide a longer-term growth driver for volumes into the future. Secondly, our positions in Visa and MasterCard benefit from inflation due to their ad valorem style revenue stream. As prices go up, Visa and MasterCard's share of the transaction remains stable, but the absolute dollar increases. Furthermore, the capex requirements for these businesses are negligible, and they have some of the highest net profit margins in the world at greater than 50%. Thus, the impact of cost inflation is minimised. Amongst the midst of all the current market volatility that we're seeing, we continue to conduct our research efforts on a range of quality businesses that we would like to own at the right price. We think looking for quality brands and retailers that are facing macro headwinds is a good use of time, as great buying opportunities may arise amongst the noise. We do not have any large positions yet, as we are being patient, but small starter positions help focus our research and offset some of the consumer factor risk in the portfolio. Some names in this space include RH, which is a luxury homewares retailer that recently we visited on our trip to San Francisco and came away wildly impressed by their offering. Lululemon, the athletic leisurewear brand with strong brand recognition and a premium price point. Deckers, who is the owner of the fastest growing footwear brand, Hoka, as well as the iconic Ugg boot brand. Fever Tree, which is a premium drinks mixer brand which disrupted the UK tonic water market and is making inroads globally across a range of categories such as soda and gingers. And in Australia, we're carefully monitoring names like JB Hi-Fi and Nick Scali. Other themes that we are currently working on and are attracted to by their industry structures, high returns on capital and pricing power, are standards-based moats, which includes FICO, who generates the standardized credit score in the US, which all the banks use for their loan and credit approvals, and luxury brands such as Louis Vuitton and Hermes, where there is a long track record of pricing power and their consumer is less impacted by a downturn. I'll now hand over to Jack, who will touch on a long and short idea. Thank you.
Thanks, Tim. As mentioned earlier, ASX 300 inclusions over the preceding year have proven to be good asymmetric short candidates, particularly companies that are pre-revenue and in the development stage of their respective business models. As we have found, some of these companies grow in popularity rapidly, with often high retail participation and no meaningful institutional ownership, meaning the ability to go short doesn't present until they reach a market cap which qualifies for inclusion into an index. At this point, passive investment vehicles are forced buyers regardless of business qualities or even any revenue, and often driving the share price higher with consistent buying into thin liquidity. Over the last 12 months, the average return of companies added to the ASX 300 index has been minus 29%, significantly underperforming in the index over the same period. A large amount of these inclusions resided within the lithium space, with the rapid increase in the lithium spot price bringing with it a flood of capital, creating hundreds of new projects and ASX listings. Whilst the initial promises of revolutionary technologies and accelerated paths to production appear great, we have found that over time, the focus can shift from the narrative to the numbers and resulting in downside to the share price alongside any decline in lithium prices. More recently, a particular company has reached the milestone of inclusion into the ASX 300, which possesses similar characteristics to successful shorts in the past, along with multiple red flags. Firstly, the company is pre-revenue with no commercial products or customers, something not typically consistent with a company valued at over $1 billion. Additionally, the company is ASX listed whilst being headquartered offshore and possesses what we would define as a colourful board, raising questions around governance. There has been an established record of financial losses along with generous levels of share-based payments relative to total spend on research and development. In fact, over the last 5 years, 41% of all company losses have derived from the payment of shares to directors and employees. Along with generous issuances to employees and directors, the company has been consistent with ongoing share issuances of capital to fund the endemic cash burn. Leading into the index inclusion, the share price has increased over 150% year to date, with index funds becoming the incremental buyer into a high retail ownership environment. This buy has now completed, and with these shares being released into borrow pools, we see the potential for downside to the current share price. Now switching to a current long position and a lot more profitable within the fund that has performed strongly over the last 6 months. Stanmore Resources. Stanmore Resources has been a listed company for over 10 years. However, the company fundamentally changed in late 2021 upon the completion of its acquisition of BHP's Queensland coke and coal assets, South Walker Creek and Poitrel. The company paid $1.6 billion for these assets via a roughly 50-50 split of debt and equity. This acquisition transformed the business fundamentally from a one-mine operation with a short mine life to a 14-year average mine life, along with a 400% increase in production to capacity of 12.9 million tonnes per annum. At the time of the acquisition, the coke and coal price resided around $200 a tonne, with Stanmore's cost of production just over $80 a tonne. 6 months later, following the Russian invasion of Ukraine, the coke and coal price briefly surpassed $600 a tonne, reflecting a significant free cash flow generation period for the company. Those high prices have since settled back to around a current spot of $340 a tonne. Yet the cash flow generated has resulted in the company being able to return to a net cash position within an accelerated time period. At the latest reporting season, BHP announced an interest to further divest its coke and coal assets within their portfolio. One of these assets, Daunia, is conveniently located next door to Stanmore's Poitrel mine, potentially unlocking significant cost synergies should they be successful within the upcoming bidding process. We believe Stanmore's successful purchase and smooth integration of BHP's previous divestments places them in good stead for the upcoming sale, and has the potential to create further increases in production and cash flow generation for the business. Stanmore is currently only covered by one sell-side broker, with a low amount of broker research having been a quality of previous successful long positions within the Alpha Fund. Additionally, The previous first half result was the first financial reporting period which includes the increased scale of the business, with historical financials representing a significantly different business in terms of production as well as cash generation. As Tim mentioned earlier, coal is in a structural undersupply due to ESG policies and a challenging regulatory political environment for both existing operations as well as any new project developments within Australia. Recent royalty scheme changes from the Queensland Government have placed a further headwind to coal production domestically, with new project investment now being seen as unfeasible by major mining corporations. Importantly, coking coal is essential in the transition to a renewable energy future that is expected to occur over the coming decades. At current met coal prices of $340 a tonne, Stanmore trades on a roughly 50% free cash flow yield, with current consensus forecasts for 2023 placing it on a 20% free cash flow yield. On longer term average met coal prices over the last 10 years, the company trades closer to a 10% free cash flow yield. Regarding the potential for more M&A activity with BHP, the company remains committed to not overpaying or being dragged into a bidding war, with many companies expressing interest as of late. Should the company be unsuccessful in acquiring the additional production tonnes, we would expect the significant free cash flow generation to be returned to shareholders over time. Whilst coking coal would not be immune from a global economic slowdown, we were able to take advantage of the long-short strategy by active positions short in companies with elevated valuations within the iron ore and copper space to offset some of the potential impact from a further deterioration in economic conditions. I'll now hand over back to Ben to wrap up the webinar.
Thank you, Jack. So in summary, we think it is still too early to get bullish on stocks with earnings and free cash flow per share coming down. Inflation remains sticky and most recession indicators are now flashing red. In the USA, we have bank failures, which could lead to tighter lending standards, and in Australia, we have the mortgage cliff approaching mid-year and large power price increases coming. History tells us that markets don't bottom before a recession and not until well after the Fed has pivoted. We aren't there yet. If you are betting on equities to bottom here and inflation to fall back to 2% before a recession and before the Fed has pivoted, you are betting on something that hasn't happened before. We are in a different world now that inflation is an issue, which means the Fed's hands are tied. The risk is that this is a longer and more drawn out slowdown than any we have seen before in our investing careers. Therefore, we continue to run lower than average net and gross exposure. Our book is tilted to low PE, cash generative longs with strong balance sheets and pricing power. Shorts in housing, banks, retail and travel, as well as expensive and unprofitable companies. 2022 has shown that we can make money in this new environment for stocks, and we are sure that there will be excellent opportunities for performance over the next few months and years. We'll now take some questions from our investors. All right, looks like we've had a couple of questions come through during the webinar. First one's a good one. What are the risks to your cautious positioning, or more simply, where could you be wrong? I think that's an excellent question. The obvious one would be that inflation starts coming down to 2%. The services inflation proves to be a lot less sticky, similar to what the goods and energy inflation was, and that we see it come down to 2% without it impacting economic growth or profits. Now, I think that's what the market is currently priced in, and I think that would be unlikely to see both of them together. So the second thing, the area we could be wrong is an aggressive step back in by central banks to stimulate economies on the back of a recession. Typically, when that's happened, markets have continued to fall for a period and it's taken time for equities to react. But there's a first time for everything. The market's been conditioned to buy Fed stimulus, to buy dips. So an aggressive re-entry by the Fed into money printing and rate cuts would potentially send equities much higher, but also then create a bigger problem in inflation down the track. So We think it's unlikely, but we could certainly been wrong. We've been wrong before. We were wrong in the second quarter of 2020 and managed to reverse course and make money over the 2-year period. We're trying to stay open-minded and nimble.
Okay, there's a few questions here coming in around coal. So just in general, what's your current view on coal? Maybe Ben, you take this one to start.
Okay, so our view on coal was that it was an area that had been significantly avoided and underinvested relative to other parts of the market when we started looking at it in early 2022. The medium to long-term supply backdrop for coal is very attractive because very difficult to get financing for new mines, very difficult to get approvals for new mines. We have reduced our coal exposure overall in 2023. There are a couple of reasons for that. One is that the thermal coal price has dropped and is now trading below where the sell side consensus has their thermal coal price forecast. So the sector, in terms of mechanically, has come downgrade to earnings from the sell side. And we've tilted that coal exposure out of thermal coal and more towards met coal, which is in the opposite setup. The spot price is trading well above where the sell side has their forecast for met coal. Met coal stocks are actually trading cheaper than thermal coal stocks at spot prices, and that is an unusual situation because met coal is a required input for the green transition or decarbonisation. Steel making is essential to our civilization, and met coal is more scarce geologically than thermal coal. So we think that's a good opportunity medium term, but we've overall reduced our exposure to the coal space. Again, with the number of recession red flags flashing, commodities have tended to be late cycle and they do sell off during recession. So that's another thing, keeping our exposure to commodities a little smaller than it was this time last year.
Okay, question here on geographic exposures of the portfolio. I'll take that one. So look, just to be clear on how we run the strategy, the exposure of the portfolio dictated by the opportunity set, not some top-down geographic allocation to where we want to be exposed. So right now we're running roughly a 50-50 split on a gross basis between Australia and global markets, and we're running slightly net short in the Aussie market and slightly net long globally, and that's purely just a function of where we're seeing the opportunities. And Ben said Australia held up quite well last year with banks and resources, and so we're pivoting some of the exposure short there. And on the long side in Australia, we're still not seeing very attractive valuations across the quality names on the long side, which is where we tend to do our investing on the long side. And just to touch on it, with geographic exposure on a currency basis, we tend to be close to about 90 to 100% hedged throughout the cycle, so that we're not taking any currency risk there.
Yeah, just to add to that, company by company, the longs that we are adding have this year been weighted towards the US, which did have a much tougher year than the Australian market last year, and the shorts that we've been adding on balance have been added in Australia.
Okay, good follow-on question then from that I can see here is, are there any stocks you have recently added to in the portfolio? Ben, do you want to take this?
Yep, Tim, thanks. There's two that we've added to through reporting season where we thought the results were acceptable to good, and where the share prices have come back a long way over the last 12 months. I actually talked about Alphabet in the recent Livewire as an AFR article as a stock we've been adding to. The stock has been impacted significantly by the announcement of Microsoft's move into AI and the ChatGPT transaction, tying their search engine Bing into the ChatGPT artificial intelligence chatbot. It's created a lot of buzz and talk about a threat to Google's core search business. We've done quite well historically buying good businesses when there's a question mark about their core viability. We did that with Visa and MasterCard at the peak of the buy now, pay later frenzy. That turned out to be reasonable buying. And the other one that worked really well was FICO, which runs credit scoring in the US. There was concerns that business model would be sunsetted or superseded by artificial intelligence, and we bought a good position in FICO, and it turned out to be great buying. So we think Google's another situation like that. Stock's been off 30+% in the last 12 months, trading now on close to a market multiple, with a ton of unmonetized upside from things like YouTube, autonomous driving, Google Cloud. The other good one is CME Group, which is basically gone sideways over the last 3 or 4 years. It is the world's largest exchange for interest rate futures trading, and also a very large marketplace for commodities. CME Group, the reported 10% top line growth, 20% bottom line growth at the last result. They should be a beneficiary as the Fed winds down its holdings of US Treasuries. As those Treasuries move into private hands, the private sector needs to hedge their exposure to those Treasuries, and that should be a nice medium to long-term tailwind for CME. So that's a monopoly business trading on a reasonable market multiple.
Yeah, it's trading on roughly around 20 times forward earnings, and that's sort of at the trough end of its long-term range. So we think that looks attractive for a strong monopolistic style business model with great pricing power, great returns on capital, high margins, and giving cash back to shareholders via dividends.
In Australia, yeah, just a plug for an old favourite in the portfolio that we thought the result was better than it has been over the last few years was Smart Group. That's a beneficiary of higher interest rates. They've come through a period of regulatory uncertainty where the government removed their ability to charge for things like add-on insurances. They've cycled all of the earnings headwind from those changes, and they're now experiencing a tailwind from novated leasing incentives for electric vehicles. So Smart Group is inexpensive, ungeared, highly cash generative, high return on invested capital business, and we've for the first time in quite a long time added to our holding in Smart Group.
Okay, got time for a few more. One here is, in the past you've spoken about unprofitable tech shorts. Do you still have exposure to this? I'll take this to start and maybe Ben can add in. Unprofitable expensive tech was the epicenter of the bubble that we recently has deflated. There was plenty of opportunities to short. It was like a pig in mud for short sellers. So it was great while it lasted, but a lot of the froth has been unwound over the last year, with like stocks anywhere from 70 to 90% down. And based off history and lessons from our portfolio is that when stocks are down that much, the elastic band effect of being short them means that the risk reward is no longer favourable, as the upside is capped to 100%, but the downside is unlimited as certain expectations come back, and they might beat or slightly do better than market expectations, and stocks are up 50-60% in very short periods of time. So we've narrowed our focus in that space to several names where we think the business model is unsustainable or the funding runway looks limited. And a key name here is a firm whose losses continue to accelerate as demand begins to soften as credit tightens up.
Yeah, I thought that was one of the takeaways from the Morgan Stanley Tech Conference this month was that the software names were probably beaten up enough. Many of them are no longer burning cash, although they're issuing stock to maintain cash levels. It was really the tech-enabled businesses like the DoorDashes, the Affirms, the Ubers, where we thought there was potentially a little bit more downside. But look, as Tim said, the easy yards on the short side were made in unprofitable names in 2022, and we are tilting our short book more towards more cyclical names that had held up very well last year, things like housing, retail, the banks on the short side.
Okay, great. We've got one here on lithium. You mentioned the lithium space previously. Have you got any updated views here?
We're still holding some shorts in the pre-revenue, pre-profit, pre-production lithium space. Many of the names are down a lot since our last webinar, but the lithium spot price is also down materially. So yeah, we're maintaining the range in lithium. We think it also gives an offset to some extent against our other long exposures in the resources space. A lot of money flooded into the lithium space on the green thematic, which pushed valuations into silly territory. They're coming back, but still probably have a way to go to get to where fundamentals say they should be.
Okay, I think we've got time for one more question. So we'll take, what's your estimate for demand destruction from higher rates?
Okay, that's a tricky one. Going to fall back to sort of anecdotal evidence and rules of thumb, but I think we've definitely seen demand destruction already from higher rates. We've had a bear market in tech. We've had thousands of layoffs in the tech space. When you go back to our comments about the reporting season just gone, we're definitely seeing a slowdown in the consumer's appetite to spend in the form of slowing like-for-likes in the retail space. We're seeing weaker cash generation from stocks across a range of industries already, and we're not into a recession yet in Australia or the US. When I talk to people in my neighbourhood about how business is going, talk to a mortgage broker on the beach on the weekend, and there's some serious pain out there. There's a lot of people that are going to have a lot of difficulty refinancing mortgages in a higher interest rate environment, and a number of businesses in the consumer discretionary space that have seen top lines down 20%, private businesses, but we think that's got to translate across to the broader equity market at some point. And one of the things we kept hearing from corporates in the US was that our assumptions from here are that things don't get any worse. Well, we think there is a risk that things get worse, and rate rises impact on a delay usually takes about 12 months, and we're just over 12 months into the rate rising cycle in the US and Australia. So now's about the time we should start to really see an accelerated impact from those previous rate increases.
Okay, great. Well, Ben, I'll hand it back to you.
Okay, Tim. All right, I think we're done with the presentation and the questions. So if you have any further questions, please don't hesitate to call or email us at ir@totuscapital.com.au, and we'll see you in 6 months. Thank you.